It's December 25th. The U.S. stock market is closed. Most desks are empty. Half the world is eating leftovers. And yet, silver just pushed into the $73 neighborhood on a holiday. That's not normal, because big moves are supposed to happen when everybody is watching, not when the room is empty. So today, we're not doing hype, we're doing a case file. What exactly happened into Christmas? Why did it happen now? And the question everyone keeps DMing me: did Tesla engineer this squeeze on purpose? Dec 25th Anomaly. Did Tesla engineer the silver squeeze? Quick reality check. What we know, what we don't. Before we go any further, 2 rules. Rule 1, engineered doesn't mean manipulated. It can mean Tesla made an engineering decision that forced a supply chain reaction. Rule 2, we're separating confirmed from speculation. Confirmed. Silver has been printing record highs into Christmas week. Reuters documented silver breaching 70 and setting fresh peaks on December 23, then tagging another all-time high on December 24. Confirmed. Christmas Eve was a shortened US session. NYSE closes early at 1 p.m. ET on the 24th of December 2025. Confirmed. MarketWatch reported silver reaching $72.75 during that Christmas Eve session. MarketWatch. Now, December 25 becomes the anomaly day because cash markets are closed, but global price discovery doesn't fully stop. Futures holiday schedules show metals reopen in the evening after Christmas Day in many venues, so the move can continue in thinner conditions across time zones. That's the setup. Now let's walk the timeline like investigators. The timeline. Why people started saying $73. Here's the clean timeline into the holiday. Dec 23. Reuters reports silver breaks the $70 psychological barrier and hits a record high around $71.49. Reuters reports silver hits another all-time high, around $72.70. Dec 2 for Christmas Eve, early close. MarketWatch reports silver reaches $72.75 before easing into the shortened close. So when people say silver hit 73, they're talking about the handle. That zone, because psychologically, 73 isn't $1 higher. It's a new altitude. And the holiday timing matters, because when liquidity is thin, the market reveals what it's afraid of. So what is silver afraid of? It's not inflation. It's availability. The Christmas week mechanism. Why holidays create violence. Let me tell you what holiday weeks do to markets. Holiday weeks create a trap called fake calm. On the surface, everything looks peaceful because fewer people are trading, but underneath, it's fragile. Because when participation drops, 3 things happen. Order books thin out, spreads get weird, one big buyer becomes a wrecking ball. So a move that would normally be absorbed by liquidity becomes a jump. And that's why a holiday squeeze is never just a chart. It's a stress test of the plumbing. Now we're going to identify the suspects. Case file. 3 suspects behind the Dec 25 anomaly. Suspect 1, liquidity. Vacuum, suspect hash 2. Physical pull, suspect hash 3. Tesla, 48 volts. Shock, suspect 1, the liquidity vacuum. Suspect 1 is simple. The market is half staff. NYSE early close on December 24 at 1 p.m. ET. Christmas Day closed. Year-end balance sheets. Risk desks telling traders, don't be a hero. So you get a vacuum. And in a vacuum, even a normal flow can look like a stampede. But the vacuum alone doesn't explain why silver, specifically, is acting like it's being hunted. That's where suspect 2 walks in. Suspect 2, the physical pull, Asia versus West. Suspect 2 is the one chart people don't show you, where physical demand is pulling from. If you want a real tell during a squeeze, you don't stare at your app. You watch premiums and benchmark behavior. Look at the Shanghai Gold Exchange daily report for December 24. Shanghai silver contracts show huge moves in yuan terms that same day. Shanghai Gold Exchange. And Reuters has already documented that London can get tight when available inventory is spoken for. Metals Focus estimated 83% of London Vault silver allocated to ETFs in late September, meaning a lot of the visible pile isn't freely floating. That's the key concept. Silver can exist in vault totals and still be hard to borrow, hard to move, and hard to source quickly. So when the market goes into a holiday window and physical logistics slow down, the question becomes, who needs metal now, not next month? That's why the Dec 25th Anomaly is scary, because holiday weeks compress time. And when time gets compressed, buyers who normally wait pay up. Now we get to suspect 3, the one everybody argues about. Suspect 3 Tesla's 48 volts. Shock. Engineering, not magic. So here's what's real and what's rumor. Real. Tesla's Cybertruck uses a 48 volts low voltage system. And Tesla explicitly warns that because it's higher voltage than typical low voltage systems, there is an increased risk of arcing and component damage if handled improperly. Tesla. Real. Texas Instruments notes that moving from 12 volts to 48 volts increases creepage and clearance requirements, impacting IC packages, PCB layout, connectors, harness design, basically the boring engineering stuff that becomes expensive at scale. Now here's where the rumor gets oxygen. When systems get less forgiving, manufacturers don't just wish reliability into existence, they buy it. And in switching and relay contexts, silver-based contact materials are widely discussed for their arc erosion characteristics. TE Connectivity specifically discusses silver contact material families and their resistance to arc erosion and welding in certain applications. So the Tesla engineered squeeze theory isn't that Tesla bought the market. It's that Tesla changed the design constraints and the supply chain smelled the consequences. And once a supply chain smells consequences, it does one thing. It front runs pain. The real question, did Tesla engineer this or did the market do it to itself? Now we're at the heart of it. When people say, did Tesla engineer this squeeze? They usually mean one of 3 things. So I'm gonna give you 3 doors. Pick the one you believe and I'll tell you what evidence would confirm it. Door A, it's just macro plus holiday thinness. Under door A, Tesla is just a headline magnet. Silver was already ripping. Reuters documented the record rally into the holiday week. Holiday liquidity exaggerates it. That's it. Confirmation signal. When desks reopen, the move fades cleanly, premiums cool, and the market acts normal. This is the holiday head fake door. Door B. Tesla didn't manipulate, but their engineering forced a supply response. This is the most plausible door. Tesla didn't need to call a trader. They didn't need to buy futures. They simply did something more powerful. They created a new standard expectation because standards do this. Standard purchasing requirement supplier tooling, multi-year lock-in, and 48 volts is not just a number. Tesla warns about arcing risk in its 48 volts system. TI explains why 48 volts increases design spacing requirements and affects connectors and layout. So supply chain people hear that and think, if this is going mainstream, I don't want to be the last buyer calling for high reliability components. Confirmation signal. Sustained physical tightness indicators, premiums persist, dislocations persist, and buying shows up even on dips. This is engineered in the engineering sense. Tesla changed constraints. The market reacted. Door C. Tesla intentionally set off a metal squeeze. This is the spicy door. And here's the truth. I have no evidence Tesla intentionally tried to squeeze the silver market, so we are not accusing people on vibes. If someone claims door C, the burden of proof is massive. Procurement documents, unusual deliveries, hard supply chain receipts. Until then, door C stays in the entertaining but unproven bin. The value part. The Dec 25th Anomaly checklist. No fluff. Now, let's make this useful. Because the only reason to watch a video like this is to leave with a playbook. Here's the Dec 25th Anomaly checklist, 9 signals that tell you what kind of move this is. Does the market hold the handle when liquidity returns? Holiday moves lie. Reopen moves tell the truth. Are there repeated record highs across multiple days? Reuters documented a stair-step of records into the holiday week. Are physical benchmarks surging? Check Shanghai daily data behavior. You're looking for persistent strength, not one print. Are London inventories spoken for? 83% allocated to ETFs is the kind of detail that matters in tight markets. Do dislocations show up? Tightness often shows up as this venue is hotter than that venue, not just one global line. Do premiums stay stubborn even if spot cools? That's the availability becoming conditional signature. Do buyers bid the dips? A real squeeze has a weird personality. It doesn't bleed out calmly. It snaps back. Do holiday schedules create gaps? Metal's holiday hours can reopen in the evening after Christmas Day. Gaps don't prove squeeze, but they magnify it. Does the Tesla story evolve from rumor to engineering receipts? Tesla 48 volts arcing warning is real. TI's creepage clearance point is real. If component suppliers start talking openly about 48 volts reliability upgrades, that's when this gets serious. What happens next? 3 scenarios. No fantasy. Here are your next 3 outcomes. Clean, realistic, no drama. Scenario 1. Holiday peak, January fade. The market cools as liquidity returns. The move was exaggerated. Scenario 2. Holiday peak dip buyers show up. Price wobbles, then gets caught. That's the signature of real procurement demand. Scenario 3. The gap up. You get a reopen move that doesn't give you a second chance because someone treated the holiday window like a sourcing deadline. And whichever scenario happens, you don't need faith. You need signals. So, did Tesla engineer this silver squeeze? Here's the honest answer. Tesla didn't have to engineer the market. They only had to engineer the problem the market is now pricing. And Christmas week is when markets accidentally tell the truth. Because the room is empty, the book is thin, and the buyers who need metal don't care about your chart. They care about time.